Ladies and gentlemen, today we stand at a critical financial crossroad. Warren Buffett, one of the greatest investors of all time, has sounded an alarm that has Wall Street and Main Street on edge. Berkshire Hathaway is sitting on a staggering $334 billion in cash, the highest in history. But why? Warren Buffett, the legendary investor and chairman of Berkshire Hathaway, has built his reputation on smart, long-term investments and a disciplined approach to capital allocation. However, recent financial reports reveal something unusual. Berkshire Hathaway is sitting on a record-breaking $334 billion in cash. This is the largest cash reserve in the company's history, far surpassing previous highs. Such a massive stockpile of cash raises an important question. Why is Buffett holding on to so much money instead of investing it? Buffett is known for deploying capital efficiently. Over the decades, he has consistently looked for undervalued businesses, solid companies with strong fundamentals, and investment opportunities that provide long-term returns. His philosophy has always been centered around value investing, which means buying stocks or businesses when they are priced below their intrinsic value. So, when a man like Buffett, who has always been eager to invest in good opportunities, is choosing to accumulate cash instead, it sends a strong signal that he sees something troubling in the market. This unprecedented cash buildup suggests that Buffett is struggling to find investments that meet his stringent criteria. With stock markets reaching all-time highs, bond yields fluctuating, and real estate markets showing signs of strain, it appears that he believes most assets are overpriced. In previous market downturns, Buffett has made bold moves, such as during the 2008 financial crisis when he injected billions into companies like Goldman Sachs and Bank of America at bargain prices. This time, however, he is not making major acquisitions, which implies he is waiting for a better opportunity. One possible explanation for Buffett's massive cash reserve is his skepticism about the current market environment. For years, low interest rates fueled rapid asset inflation, pushing stock prices to historic highs. However, with central banks tightening monetary policy and raising interest rates, the economic landscape is shifting. Higher borrowing costs mean corporations are less inclined to take on debt, which could slow growth and lead to lower earnings, something Buffett and his team are likely anticipating. Another factor could be rising market volatility. Inflation, geopolitical tensions, and economic uncertainty have all contributed to unpredictable swings in stock prices. Buffett has often spoken about the importance of stability and predictability when making investment decisions. If he believes that today's market is too unstable or uncertain, he may prefer to sit on cash rather than take unnecessary risks. This aligns with one of his most famous quotes: "The stock market is a device for transferring money from the impatient to the patient." By holding on to cash, he is practicing the patience that has made him one of the most successful investors in history. The significance of Buffett's cash hoard becomes even clearer when compared to past trends. Historically, he has used excess cash to repurchase Berkshire Hathaway's own stock when he believes it is undervalued. However, even buybacks have slowed, indicating that he may think his own company's shares are also priced too high. If Buffett does not see value in his own stock or other companies, it suggests that markets may be dangerously overvalued. For the average investor, Buffett's actions serve as a crucial lesson. While many market participants chase high returns and risky investments during boom cycles, Buffett remains disciplined. His decision to hold cash instead of buying into an inflated market reinforces the idea that sometimes the best move is to do nothing and wait for better opportunities. Investors who follow his lead can learn that capital preservation is just as important as capital growth. As history has shown, Buffett rarely makes knee-jerk reactions. If he is sitting on this much cash, it is not by accident. He is likely waiting for a significant market correction or an economic downturn that will create once-in-a-decade investment opportunities. When that time comes, Buffett will be ready to deploy his capital strategically, buying quality assets at steep discounts just as he has done in the past. The real question now is, what does Warren Buffett see that others don't? If he is preparing for a market downturn, should individual investors also take a more cautious approach? While no one can predict the exact timing of a market crash, one thing is certain: when Buffett makes his next big move, the world will be watching. Warren Buffett is widely regarded as one of the most disciplined investors of all time, with a keen eye for spotting undervalued assets. Throughout his career, he has consistently emphasized that price and value are not the same thing. A stock may be expensive, but that does not necessarily mean it is valuable. His investment philosophy revolves around finding companies with strong fundamentals, competitive advantages, and long-term growth potential. Yet, despite the availability of thousands of companies in the stock market, Buffett is not buying in a significant way. This signals a deeper issue. He believes that there are currently very few, if any, attractive investment opportunities. For an investor like Buffett, this is an unusual position to be in. He has built Berkshire Hathaway into a powerhouse by strategically acquiring businesses and stocks at opportune moments. However, the fact that he is holding on to an unprecedented $334 billion in cash rather than deploying it suggests that he sees more risks than rewards in today's market. Historically, Buffett has made some of his best investments during times of market turmoil. When others are fearful, he steps in and buys assets at a discount. The fact that he is waiting on the sidelines now suggests that he believes assets are currently overpriced and that a better opportunity will emerge in the future. One of the biggest reasons Buffett may be struggling to find good investments is the overvaluation of stocks. The U.S. stock market in particular has been trading at historically high price-to-earnings (P/E) ratios, with many companies valued at levels that seem disconnected from their actual earnings potential. When markets are this inflated, the risk of a correction or crash increases. And Buffett is known for avoiding speculative bubbles. His reluctance to invest right now indicates that he is unwilling to buy into an overheated market where stock prices are not justified by fundamentals. Another reason Buffett may be hesitant to deploy capital is the current interest rate environment. For years, ultra-low interest rates fueled a surge in asset prices, making borrowing cheap and encouraging companies to expand aggressively. However, as central banks raise rates to combat inflation, borrowing costs have increased, putting pressure on corporate profits and consumer spending. Higher interest rates also make risk-free assets like treasury bonds more attractive, which could explain why Buffett is opting to hold cash rather than invest in stocks that may see declining returns. Additionally, the mergers and acquisitions landscape has become less favorable. Buffett has always been on the lookout for companies that he can acquire outright, but with sky-high valuations and increased regulatory scrutiny, large-scale acquisitions have become more challenging. If businesses are demanding premium prices for buyouts, Buffett may prefer to wait for more reasonable valuations rather than overpay for assets that may not generate strong returns. His lack of investment activity also extends to share buybacks, a common strategy used by Berkshire Hathaway to return value to shareholders. In the past, Buffett has repurchased Berkshire's stock when he believed it was trading below its intrinsic value. However, even his own company's stock has not seen aggressive buybacks recently, which suggests that he may feel that Berkshire itself is not a bargain at current prices. This further reinforces the idea that the market as a whole is overvalued. Buffett's strategy of holding back from investing serves as a lesson for individual investors. Many retail investors feel pressured to chase the market, buying into stocks simply because prices are rising, fearing they will miss out on potential gains. However, Buffett's discipline reminds us that sometimes the best investment decision is to do nothing. Instead of chasing trends, he is choosing to be patient, waiting for a time when stocks are priced more reasonably. This aligns with one of his most famous principles: be fearful when others are greedy and greedy when others are fearful. Right now, it seems he believes there is too much greed in the market and he is exercising caution. The fact that Buffett is not investing heavily despite having record cash reserves should not be ignored. It signals that he sees more downside risk than upside potential in the current market. Whether it is due to overvaluation, rising interest rates, or macroeconomic uncertainties, Buffett's actions suggest that he is waiting for a better entry point. And when that moment comes, he will be ready to deploy his capital strategically, buying into undervalued assets when others are forced to sell. For those looking to navigate today's market, Buffett's approach serves as a reminder that opportunities will always come, but patience is key. Instead of blindly investing in an overheated market, it might be wise to take a step back, build liquidity, and be prepared for when better opportunities arise. The real question is, how long will Buffett wait, and what will trigger his next big move? Investors around the world are watching closely because when Buffett finally acts, it will provide a major clue about where the market is headed next. For years, financial analysts and economists have been warning about the emergence of the everything bubble, a term used to describe the rapid rise in prices across multiple asset classes, including stocks, bonds, real estate, and even cryptocurrencies. Unlike past economic bubbles that were concentrated in one specific sector, such as the dot-com bubble of the late 1990 or the housing bubble of 2008, the current situation appears far more widespread. Fueled by low interest rates, excessive liquidity, and aggressive monetary policies, nearly every major asset class has seen valuations soar to record highs. Now, with economic conditions changing, many are asking the inevitable question, is the bubble about to burst? One of the primary drivers of the everything bubble has been the era of cheap money. For more than a decade, central banks around the world kept interest rates at historically low levels to stimulate economic growth following the 2008 financial crisis. This made borrowing cheaper, allowing companies to expand, investors to take on more risk, and asset prices to rise across the board. However, this easy money era is coming to an end. Central banks, led by the Federal Reserve, have been aggressively raising interest rates to combat inflation, making borrowing more expensive. As a result, the cost of capital is increasing and businesses and consumers are feeling the pressure. One of the most visible signs of the everything bubble is the stock market's extreme valuations. Over the past decade, the S&P 500 and other major indices have reached record highs, often driven by a handful of mega-cap tech stocks. While these companies have shown strong growth, many analysts argue that their valuations are no longer justified by their earnings potential. When price-to-earnings (P/E) ratios become too inflated, it suggests that stocks are trading at levels disconnected from their fundamentals. Historically, such conditions have led to sharp market corrections. Another key area of concern is the real estate market. Home prices in many parts of the world have skyrocketed, driven by low mortgage rates and high demand. Investors and homeowners rushed to buy properties, believing prices would continue to rise indefinitely. However, as interest rates climb, mortgage payments become more expensive, reducing affordability for buyers and cooling demand. This is already leading to a slowdown in housing markets, with some regions seeing price declines. If the trend continues, it could have ripple effects on the broader economy, as real estate is a major driver of wealth and consumer spending. The bond market is also flashing warning signs. For years, bonds offered low yields, forcing investors to take on more risk in search of higher returns. However, as interest rates rise, existing bonds with lower yields become less attractive, causing their prices to drop. This has led to one of the worst years on record for bond investors. Additionally, governments and corporations that relied on low interest rates to finance debt are now facing higher borrowing costs, increasing the risk of defaults. If credit markets tighten, companies may struggle to refinance their debts, leading to potential bankruptcies and layoffs. Even cryptocurrencies, once hailed as a hedge against inflation and a new financial revolution, have not been immune to the everything bubble. Bitcoin and other digital assets saw massive surges in value, driven by speculation and institutional interest. However, the sharp crashes in crypto markets over the past few years highlight the volatility and risk associated with these assets. Many projects that promised high returns have collapsed, wiping out billions in investor wealth. The speculative frenzy that once fueled crypto's rise is now being tested by tightening financial conditions. If the everything bubble does burst, the consequences could be severe. A major market correction could lead to a loss of investor confidence, a decline in household wealth, and reduced consumer spending, all of which could trigger a recession. Additionally, financial institutions and corporations that have taken on excessive leverage during the boom years may find themselves unable to cope with higher interest rates and slowing economic growth. The domino effect of falling asset prices, rising debt costs, and economic contraction could lead to a prolonged period of financial instability. This is where Warren Buffett's massive cash reserves become particularly significant. His decision to hold on to $334 billion instead of investing suggests that he sees the risks associated with the everything bubble and is preparing for the aftermath. Buffett has historically been a contrarian investor, meaning he avoids buying into overvalued markets and instead waits for downturns to deploy capital strategically. If he believes that asset prices across the board are unsustainable, it reinforces the idea that the market may be heading toward a significant correction. For individual investors, this serves as a cautionary tale. During boom times, there is often a tendency to believe that asset prices will always go up, leading to excessive risk-taking. However, history has repeatedly shown that markets move in cycles, and what goes up eventually comes down. The key takeaway from Buffett's actions is that risk management and patience are critical. Rather than chasing speculative gains, investors should focus on financial stability, diversification, and preserving capital in uncertain times. As we move forward, all eyes will be on the markets to see whether the everything bubble will deflate gradually or collapse suddenly. Either way, Buffett's actions suggest that he is prepared for major turbulence ahead. The question is, are you? Warren Buffett's massive cash reserves and cautious approach to investing have sparked widespread speculation about his next move. Historically, Buffett has made some of his best investments during times of crisis, when markets are in turmoil and asset prices are significantly lower. His decision to hold on to $334 billion in cash rather than deploying it suggests that he may be anticipating a major market downturn. If a crash occurs, it would present the perfect opportunity for Buffett to use his cash reserves to acquire valuable assets at deeply discounted prices, just as he has done in previous economic downturns. One of Buffett's most famous investment strategies is to buy when others are fearful. During the 2008 financial crisis, when markets were collapsing and investors were panicking, Buffett made strategic investments in companies like Goldman Sachs, Bank of America, and General Electric. At that time, these businesses were struggling with liquidity issues, but Buffett's cash injections provided them with much-needed capital. In return, he secured favorable deals such as high-interest preferred stock and stock warrants, which later resulted in billions of dollars in profits for Berkshire Hathaway. This approach has proven highly successful in past market downturns, and Buffett may be preparing to do something similar if another crash occurs. One key factor that could trigger a market correction is the rising cost of debt. For years, businesses and individuals have taken advantage of low interest rates, borrowing heavily to finance expansion, stock buybacks, and consumer spending. However, as interest rates rise, the cost of servicing debt increases, putting pressure on corporate profits and household budgets. Companies that have relied on cheap financing may struggle to refinance their debt, leading to corporate bankruptcies, job losses, and a slowdown in economic growth. Buffett's cash reserve puts him in a prime position to acquire distressed assets at a fraction of their previous value when struggling companies are forced to sell. Another factor that could contribute to a market downturn is declining investor confidence. Over the past decade, the stock market has seen unprecedented levels of speculation, driven by retail investors, hedge funds, and institutional traders seeking high returns. However, as economic uncertainty increases, many investors may begin pulling their money out of risky assets, leading to sharp sell-offs and market volatility. Buffett has always been skeptical of speculative investment trends, preferring companies with strong fundamentals and long-term value. If the market crashes, he will likely be watching for high-quality businesses that become temporarily undervalued, allowing him to buy at a discount. The housing market is another area where Buffett may be looking for opportunities. Real estate prices have soared over the past decade, largely due to low mortgage rates and high demand. However, as interest rates rise, mortgage payments become more expensive, reducing affordability for home buyers. This could lead to a slowdown in housing markets and in some cases even a housing market correction. If real estate prices decline significantly, Buffett could take advantage of distressed properties or real estate investment trusts, REITs, that become undervalued. Given Berkshire Hathaway's previous investments in real estate businesses, including Home Services of America, he may be watching this sector closely. Buffett's strategy of waiting for a downturn also reflects his broader investment philosophy of patience and discipline. Unlike many investors who feel the need to constantly buy and trade stocks, Buffett understands that sometimes the best move is to do nothing and wait for the right opportunity. His decision to hold such a large amount of cash instead of chasing overvalued stocks suggests that he is confident that better deals will emerge in the near future. When the market does correct, Buffett will likely move quickly, deploying his cash reserves to make high-quality acquisitions. For individual investors, Buffett's approach serves as an important lesson. Many people try to time the market, buying when prices are high out of fear of missing out, and then selling when panic sets in. However, Buffett has repeatedly emphasized the importance of long-term investing, financial discipline, and capital preservation. His current cash position suggests that he sees significant risks in today's market, and rather than taking unnecessary risks, he is choosing to stay patient and wait for the right moment to invest. As history has shown, market cycles are inevitable. Economic booms are often followed by downturns, corrections, and recessions. While no one can predict exactly when the next crash will happen, Buffett's actions suggest that he believes a major downturn is not far off. The key takeaway is that when the market does decline, those who have prepared by holding cash, staying out of excessive debt, and focusing on strong fundamentals will be in the best position to take advantage of new opportunities. Buffett's strategy of waiting for the right moment to invest rather than chasing inflated prices is one that all investors should consider as economic uncertainty continues to grow. One of the biggest risks looming over the global economy is the potential for a severe recession, and Warren Buffett's massive cash reserves suggest that he may be preparing for one. A recession occurs when economic growth slows significantly, leading to declining corporate profits, higher unemployment, and reduced consumer spending. While markets have remained resilient over the past few years, several key indicators suggest that a downturn could be on the horizon. If that happens, Buffett's strategy of holding cash will prove invaluable, allowing him to capitalize on opportunities while others are forced to sell. One of the strongest warning signs of a potential recession is inverted yield curves, which occur when short-term interest rates are higher than long-term rates. This phenomenon has historically been a reliable predictor of economic downturns. In recent years, the U.S. Treasury yield curve has inverted multiple times, suggesting that investors are worried about future economic growth. When yield curves invert, it signals that financial markets expect a slowdown, and businesses may cut back on investments, hiring, and expansion. Buffett's decision to hold onto cash rather than investing heavily suggests that he may be anticipating an economic contraction in the near future. Another major factor contributing to recession concerns is inflation and rising interest rates. Inflation has been a persistent issue in recent years, driving up the cost of living for consumers and increasing expenses for businesses. In response, central banks have raised interest rates aggressively, making borrowing more expensive. Higher interest rates slow down economic activity by reducing consumer spending and increasing the cost of debt for businesses. If economic growth slows too much, it could trigger a full-blown recession, leading to job losses and financial instability. Buffett's reluctance to invest heavily in the current market suggests that he sees these risks as significant and is waiting for a better entry point. Corporate debt levels also pose a major risk to the economy. Many businesses took advantage of low interest rates over the past decade to borrow heavily, using the funds for expansion, stock buybacks, and acquisitions. However, as rates rise, the cost of servicing this debt increases, putting pressure on companies with high levels of leverage. If businesses struggle to meet their debt obligations, it could lead to defaults, layoffs, and declining stock prices. Buffett, who has always prioritized financial stability, may be preparing for a wave of corporate distress, positioning himself to acquire undervalued businesses once the economy weakens. Consumer debt is another area of concern. Many households have accumulated significant debt, including mortgages, auto loans, and credit card balances. With inflation driving up everyday expenses and interest rates making debt more expensive, many consumers are now struggling to keep up with payments. If unemployment rises, more people may default on their loans, leading to a decline in consumer spending, which is a key driver of economic growth. Buffett's decision to hold cash rather than investing in companies reliant on consumer spending suggests that he may expect financial strain on households to worsen before conditions improve. The global economy is also facing risks from geopolitical instability, which could contribute to a recession. Ongoing conflicts, trade tensions, and supply chain disruptions have already impacted global markets, creating uncertainty for businesses and investors. In times of geopolitical turmoil, companies often delay investments, and consumers may cut back on spending due to economic uncertainty. Buffett has historically been cautious during periods of global instability, preferring to wait until market conditions stabilize before making major investment decisions. His current cash position suggests that he is concerned about the broader economic environment and is preparing for potential turbulence ahead. Despite these risks, recessions also create opportunities for long-term investors like Buffett. In previous downturns, he has used economic crises as an opportunity to buy high-quality businesses at discounted prices. If a recession does occur, he will likely use his massive cash reserves to acquire valuable assets at bargain valuations, just as he did during the 2008 financial crisis. While many investors panic and sell during downturns, Buffett's strategy has always been to remain patient and take advantage of market corrections. For individual investors, Buffett's actions offer a valuable lesson. Many people react emotionally to market volatility, selling stocks when prices drop and buying when prices are high. However, Buffett's approach is the opposite. He waits for economic downturns to find opportunities, ensuring that he gets the best deals when others are fearful. His patience and discipline highlight the importance of long-term thinking, risk management, and financial stability. As concerns about a potential recession continue to grow, Buffett's massive cash reserves suggest that he believes a downturn is inevitable. The real question is not if a recession will happen, but when. Investors who are paying attention to Buffett's strategy can learn from his cautious approach, focusing on capital preservation and waiting for the right moment to invest. If history is any guide, Buffett will be ready to act when the time is right, and those who follow his lead may benefit from the opportunities that emerge during the next economic downturn. Warren Buffett's massive cash reserves are not just a sign of caution, they are also a strategic advantage that positions him to capitalize on opportunities when markets decline. While many investors remain fully invested during market booms, Buffett's decision to hold $334 billion in cash means that he has the flexibility to make big moves when the right moment arises. His approach reflects a key principle of investing. Patience and discipline pay off when others panic. By waiting for asset prices to drop, Buffett ensures that he can buy valuable businesses and stocks at deeply discounted prices when market conditions shift. One of the biggest advantages of holding cash is liquidity. When markets crash, many investors are forced to sell their assets at a loss due to margin calls, debt obligations, or sheer panic. Those with cash, however, are in a position to buy assets at bargain prices while others are desperate to exit the market. Buffett has used this strategy effectively in the past. During the 2008 financial crisis, when banks and major corporations were struggling, Buffett stepped in with cash to make strategic investments. He secured lucrative deals with companies like Goldman Sachs and Bank of America, providing them with emergency funding in exchange for high-interest preferred shares and stock options. As markets recovered, these deals generated billions in profits for Berkshire Hathaway. His ability to make such bold moves was only possible because he had cash on hand when others didn't. Another benefit of Buffett's cash reserves is stability during economic uncertainty. Markets are highly unpredictable and downturns can last for extended periods. Many investors who stay fully invested during market booms risk significant losses when a correction or crash occurs. Buffett, however, avoids this risk by maintaining a strong cash position, ensuring that Berkshire Hathaway is never forced into a desperate situation. His cash reserves serve as a buffer against volatility, allowing him to wait for the right opportunities rather than reacting emotionally to market swings. This strategy reflects one of his famous investing principles: be fearful when others are greedy, and greedy when others are fearful. In addition to stock market opportunities, Buffett's cash reserves allow him to acquire entire businesses at attractive valuations. Berkshire Hathaway is known for buying high-quality companies outright, rather than just investing in stocks. In previous downturns, Buffett has acquired businesses in industries such as insurance, energy, manufacturing, and consumer goods at times when valuations were lower. When economic conditions become difficult, some businesses may struggle with liquidity issues, forcing them to seek investors or sell assets at a discount. Buffett, with his massive cash war chest, is well positioned to take advantage of such situations, acquiring businesses with strong long-term potential at bargain prices. Buffett's strategy also highlights the importance of having the flexibility to act when opportunities arise. Many investors become trapped in overvalued markets, feeling pressured to chase returns, even when asset prices are inflated. However, Buffett's willingness to sit on cash, even during long bull markets, demonstrates that he is not interested in chasing short-term gains. Instead, he waits for market inefficiencies and downturns to create opportunities that align with his investment philosophy. His approach requires patience, but history has shown that it consistently leads to long-term success. For individual investors, Buffett's strategy serves as a powerful lesson in risk management and capital preservation. Many people make the mistake of going all in when markets are booming, only to suffer massive losses when conditions change. Buffett's disciplined approach shows that having cash on hand is not just about avoiding losses, it's about being ready to take advantage of downturns. By maintaining liquidity, investors can position themselves to buy assets at lower prices when the market inevitably corrects, rather than being forced to sell at the worst possible time. Buffett's massive cash reserves signal that he is waiting for a significant buying opportunity. He has seen countless market cycles throughout his career and understands that periods of excess are often followed by corrections. His decision to hold on to cash suggests that he sees current market conditions as overheated and is waiting for prices to come down before making his next major investments. When that moment arrives, Buffett will be ready, and those who follow his disciplined approach may also find themselves in a position to benefit from the opportunities that emerge during market downturns.